Everyone loves a simple story with a clear bad guy. For 2008, we cast the greedy Wall Street banker in the lead role. It's a satisfying picture, isn't it? Guys in expensive suits laughing maniacally while setting fire to piles of money that used to be your pension. And sure, there was an astronomical amount of greed. To say Wall Street had a compensation problem is like saying the ocean is a bit damp. But blaming only them is like blaming the iceberg for the Titanic. It was big, it was a problem, but someone had to be steering the ship directly at it with the lights off while playing loud music. To find our real culprits, we need to look at the people who built the ship, sold the tickets, and insisted icebergs were a myth invented by polar bears. Our story really kicks into high gear in 1999. The government, in its infinite wisdom, decided that a law from the Great Depression was just too old-fashioned. The Glass-Steagall Act had one simple job: keep the boring part of banking, your savings account, separate from the fun casino-style part, which is investment banking. Repealing it was like removing the wall between the zoo's lion enclosure and the petting zoo. What could possibly go wrong? This allowed commercial banks to gamble with their depositors' money, creating supermarkets of finance. Then, in 2000, they went further, passing a law that basically made a whole category of financial bets, called derivatives, completely unregulated. The government's official position was that the market was a magical, self-policing adult that didn't need a babysitter. An interesting take. So, with the rulebook and the shredder, Wall Street got creative. They started bundling thousands of mortgages together. Think of it like a giant smoothie of debt. Some of these mortgages were great, given to people with perfect credit. Many others were not. These were subprime loans, given to people with the financial stability of a unicycle on a tightrope. Wall Street's geniuses blended all these loans, good, bad, and awful, into a new product called a collateralized debt obligation, or CDO. They claimed that by mixing the bad loans with the good ones, the risk just kind of disappeared. This is financial alchemy. They convinced everyone they could turn lead into gold. And for a while, everyone made a fortune selling shiny gold-painted lead. Now, you might be thinking, surely someone was checking if this stuff was actually valuable. Enter the credit rating agencies. Companies like Moody's and Standard & Poor's. Their entire job was to be the sober, impartial referee. Instead, they became paid cheerleaders. The banks would pay the agencies to rate their shiny new CDOs. And if one agency didn't give them the top-tier AAA rating they wanted, the bank would just go to a competitor who would. Shockingly, this created a race to the bottom, where incredibly risky bundles of subprime junk were given the same safety rating as U.S. government bonds. It's like a food inspector giving a 5-star hygiene rating to a dumpster hot dog because the dumpster owner paid him to. Everyone knew it was a joke, but the checks kept clearing. This whole bonfire needed fuel, and that fuel was cheap money. After the dot-com bubble burst, the Federal Reserve, led by Alan Greenspan, slashed interest rates to near zero. This made borrowing money incredibly, ridiculously cheap. At the same time, countries like China had massive savings they wanted to invest somewhere safe. They saw those AAA-rated mortgage products from the US and thought, perfect, the safest investment in the safest country. So, a tidal wave of global capital flooded into the US housing market, pushing prices up and demanding more and more of these mortgage-backed securities. The system wasn't just a US problem, it was a global machine, and every part of it was screaming for more fuel, no matter how toxic it was. And who was at the bottom of this pyramid? The average person who just wanted to own a home. Government policy for decades had pushed home ownership as the ultimate goal, a cornerstone of the American dream. This pressure created a huge demand. Mortgage brokers, incentivized by commissions, had no reason to say no to anyone. Ninja loans became common. No income, no job, or assets. Seriously? People were signing up for adjustable rate mortgages they couldn't possibly afford once the low teaser rate expired. Was it predatory? Absolutely. Were some people irresponsible? Sure, but when the entire financial, political, and regulatory system is screaming at you to buy a house you can't afford with a loan you don't understand, it's a bit much to pin the whole collapse on the person who signed the dotted line. For years, this all worked because house prices only ever went up. People could just refinance when their rates adjusted. But in 2006, the bubble popped. House prices stopped rising, then they started to fall. Suddenly, all those adjustable rate mortgages reset to their actual, horrifyingly high rates. Defaults skyrocketed. That smoothie of debt? It turned out to be poison. The CDOs, once rated AAA, were suddenly worthless. Banks looked at each other and realized nobody knew who was holding the toxic garbage. The trust that holds the financial system together vanished overnight. On September 15, 2008, Lehman Brothers, a 158-year-old investment bank, declared bankruptcy. That wasn't just one domino falling, it was the hand that pushed the entire table over. The global financial system froze solid. So, who were the real culprits? There wasn't just one. It was a perfect storm of failure. Politicians who dismantled decades of sensible regulation for political ideology, central bankers who kept the money faucet on full blast for too long, Wall Street alchemists who privatized profits and socialized losses, rating agencies that sold their credibility for cash, and a global system that demanded impossible, endless growth. The government eventually bailed out the banks, arguing they were too big to fail. A strange conclusion considering they had just, failed. Spectacularly. The real lesson wasn't about a few greedy individuals. It was about how a system, designed by humans, can create incentives so perverse that a global catastrophe becomes not just possible, but predictable. If you enjoyed this video, please like, comment, and subscribe to our channel for more historical insights. Thanks for watching, nerds!